Welcome to the Zions Bank Economic Update. My name is Joseph Mayans, and joining me is senior economist Robert Spendlove to discuss the current economic conditions. Robert, really, if you've been watching the news recently, all the headlines have been dominated kind of by the U.S. China trade war that's going on. But really also, in addition to that, over the past few weeks, we've had a lot of new economic data points come out. We had GDP, we had the latest employment report, we had the Fed meeting. So before we get into the trade issues, why don't you walk us through what we're seeing in the other side of the economy?
Yeah, thanks, Joseph. It's been a really interesting month, and we've seen a lot of kind of a variety of different economic data. And this is one of the things the Fed is struggling with is, when the economy is going up, most indicators are showing up. When it's going down, they're showing down. But right now, we're seeing a lot of mixed indicators, and it makes it much more difficult to kind of tell exactly where the economy is going. So if we look at those, one of the main sources of economic information, the broadest measure of the economy, is gross domestic product. And so we got new numbers for the second quarter of 2019 GDP. What we see is it came in around 2.1%. Not great. It's a little bit slower than the 3.1% we saw in the first quarter, but not too bad. However, what was a little bit surprising was the revisions to the past estimates. So when the government estimates GDP, they do multiple revisions. You can see that in here. The blue is the initial and the yellow is the revised. And what we saw was that for 2018, they actually revised down the estimate of GDP from about 3% down to about 2.5%. So it's a little bit slower than we had anticipated. And if you remember, the Trump administration's goal was to have 3% growth. And so we initially thought we had that 3% in 2018. Now we think it's closer to 2.5%. So just a little bit weaker than we would have hoped to see on the top line. Now, when we break it down into the parts, kind of the main parts of GDP, consumer spending, business spending, and net exports, in addition to government spending. But when you look at this, so on the left, we've got consumer spending. Really strong growth, above 4%. The consumer is about 2/3 of the economy. So it's good to see consumers still feeling good. Consumer confidence is strong, and we're seeing good growth there. However, look at the business spending. Business spending not only just slowed, it actually went negative. That's the first time we've seen a contraction in business spending for several years in GDP. And that's a sign that businesses are getting nervous. They're holding back. We're not seeing the kind of production that we've seen in recent history. Also, a lot of people say, well, what about the tax changes that Congress passed in the last few years? You can see that impact right here. Right around 2018, we saw big growth around 8%, but essentially the effects of that have gone away, and now we're seeing some troubling signs here. And then when we look at exports, this is another area, and this is being directly hit by the trade war. We see a big contraction in net exports dropping by over 5%. Now, I would say that both net exports and business investment are being impacted by the trade war and the kind of the fears of the unknown that we're seeing so much with the trade war. But hopefully, if consumers can keep confidence up, then we'll be okay. But that's what we're watching really closely. Now, a different report, and this is the monthly jobs report, is another really important one. It's one the Fed watches really closely. The jobs report came out really strong. So we're expecting 157,000 jobs to be created. We got 164,000. And so a little bit above our expectation, also consistent with what we've seen over the last year. Now, it is a little bit slower than we saw in 2018. We were over 200,000 on average for 2018, but still a pretty good number. And in addition to this, we saw the unemployment rate stayed very low. Labor force participation actually ticked up a little bit, so we're pulling more people off the sidelines, and even wage growth accelerated a little bit. So all pretty good signs of how the economy is doing in terms of the job market. So that's kind of one of the positives. But then when we look at kind of the result, so what did the Fed do? And because they've got these mixed indicators, there was some question about whether they would actually cut rates. Well, they did. The Fed decided to cut rates by 25 basis points, the first time they've cut rates since the Great Recession. So it's significant to see a reversal in the Fed's policy. And what people were really paying attention to was what the Fed said. as part of their explanation of why they cut the rates. And so if anyone was paying attention to the markets, the day that the Fed made this decision, markets dropped significantly, not because of what they did, because of what they said. And Chairman Powell said this is essentially a mid-cycle adjustment, and markets really want the Fed to continue dropping rates. And he said, don't be so sure that we're going to keep on going. And so the Fed is still reluctant. They don't want to drop rates all the way down to zero again, because then they don't have tools when a recession hits. But we'll be watching really closely to see what the data looks like. The Fed did specifically mention concern about inflation as one of the areas that they're watching, and also concern about the trade war is an area that the Fed is really worried about.
Robert, so you mentioned a couple times about the trade war, and I know that's something that the Fed spoke on at length at their latest meeting. You know, we've really seen an escalation over the past couple days, and even a couple weeks ago, we put out a report entitled "Nobody Wins a Trade War," and it kind of seems like that's really what we're seeing now, kind of losers on both sides of that. Why don't you walk us through a little bit what we're seeing?
Yeah, and it's almost like the difference between hard and soft economic data. So when we look at our hard data, like GDP, like jobs, we can kind of have a glimpse of what the economy looks like. But then there's the unknown, that black swan that is the trade war. And that's what the markets are really worried about. That's what a lot of businesses are worried about, because we just don't know what's going to happen next. Essentially because we're getting the announcements via tweets. And so it does create a lot of uncertainty. But what are the effects of that we're seeing? Well, number one, it is having an impact on the Chinese economy. So the latest, this is the Chinese GDP, came in at 6.2%. Sounds great if you're comparing it to the U.S. 2.1, but you'll see it's the lowest economic growth that China has seen in 27 years. So China is really seeing a slowdown, a lot of pressure on their overall economy. And then when we look at directly kind of imports coming from China into the US, you can see that it's dropped off significantly, down 12.3%. So it's really having a big impact on those Chinese imports. Now, one effect is we can see that Mexico is now the largest trading partner for the United States. And China is trying to get around the tariffs. So that's why we see big increases in South Korea or Taiwan or Vietnam. However, they can only go so far in trying to get around that and moving their products to other places. It is having a real impact on the Chinese economy, and it is hurting the Chinese economy. But the thing we need to keep in mind is China is not isolated. China is the second largest economy in the world, and much of the European economy is reliant on the Chinese economy. So if the Chinese economy starts to hurt, we start to see pain in Europe, and we're seeing that in places like Germany, where their net imports are dropping and a lot of their industrial production is dropping. So we're starting to see, we call that contagion, where problems start to spread to other parts of the world. And then it even starts to come back into the US. So this is US manufacturing jobs. We can see there was a big run-up in manufacturing jobs leading up to the beginning of the trade war. As soon as those tariffs started, we started to see manufacturing jobs slowing down. And the stated goal of the trade war, of the tariffs, was to kind of boost US manufacturing, but we haven't seen that. We've actually seen manufacturing coming down and overall industrial production in the US coming down as well. The second part is, and this is one of the real fears, where a tariff turns into a trade war, turns into a currency war. And that's kind of the latest that we've seen from the Chinese. So the Chinese has been manipulating their currency for years and years. But they've kind of held back in the way that they manipulate it until recently. The Chinese essentially pushed the value of the yuan, their currency, up and forced it to be, and there's a critical range right here at essentially 7 yuan per dollar. And they pushed it above that critical level. That's what really set off the markets. The day that this happened, the Dow Jones Industrial Average dropped 750 points. So there's a lot of concern that Chinese further manipulation of their currency will cause an escalation in the trade war and even more problems. And so we can really see how even if we have pretty good solid data, that it's that unknown and that potential for even worsening relations and an escalation of the trade war can really cause markets and individuals to be nervous.
Yeah, absolutely. You talked a little bit how the stock market dropped pretty significantly after the Chinese devalued their currency. And we haven't even hit on, China said they're going to stop importing U.S. ag products. That's a whole nother part of the economy that's going to have a big impact on. So something to watch. Thank you for joining us for this economic update. For more information and analysis, please visit zionsbank.com/economy.